The stock market has performed well in the fourth quarter and for the year 2023 so far. But how will things shape up in 2024 with ongoing high interest rates, economic weakness overseas, and a presidential election in front of us? Hello and welcome to the Cedar River Capital Market Touchstones slideshow update for the fourth quarter of 2023. The date today is December 12th, 2023, and today we'll be discussing these and other factors driving the stock and bond markets. My name is Paul Latta. As in prior slideshows, I'll be doing the speaking today, but my business partner, Baj Kochar, and I are both available for questions and discussion. Our contact information is on our website at cedarrivercapital.com. Our agenda today will begin with a discussion about the recent market action. We'll then look at the macroeconomy to put a more quantitative context into the market discussion. Then we'll move to a microeconomic view and look at key industry-specific drivers. And then we'll conclude with a longer-term observation about the investment landscape. The S&P has done well over the last 5 years, though we are still a touch below the high set in January of 2022. Specifically, we're about 4% below the all-time highs. For the year through December 8th, the S&P has returned 21.8%. While the stock market has been healthy over the last 5 years, the bond market has struggled, as you can see here. The last 3 years in particular have seen negative returns, and the year 2022 was actually the worst bond market in over a century. Bond market performance is strongly tied to interest rates, so the Federal Reserve's rate hiking campaign has been especially tough on the bond market. With inflation gradually subsiding, that headwind for bonds appears to be tapering off, making the bond market appear more investable. The Fed's rate hiking campaign raised overnight Fed funds to the highest level in over 20 years. But the last hike was in July, and at subsequent Fed meetings in recent months, the Fed has elected to not raise rates any further. We're now in a holding pattern. And with monthly inflation figures gradually softening, the street consensus is for the Fed to begin cutting rates in the first half of next year. Here we can see the implied probabilities of Fed rate cuts at future Fed meetings. These probabilities are based on Fed funds futures. As shown in the blue squares, the most likely scenario is that the Fed will make its first rate cut at the meeting on March 20th. In fact, a total of 6 rate cuts is expected over the course of 2024. With street consensus that the Fed will be cutting rates next year, it shouldn't be a surprise that short-term rates are actually higher than long-term rates. That said, it is unusual for short-term rates to be higher than long-term rates. Indeed, it should be intuitive that long-term bonds generally pay more than short-term bonds since long-term bonds have more duration risk. That is, long-term bonds held to maturity have more risk of some sort of black swan event disrupting the credit compared to short-term bonds. But as we can see here, the short-term bonds are yielding nearly a full percentage point higher than the long-term bonds. The unusual yield inversion has been with us for over a year. Usually long-term bonds yield about 1 to 2 percentage points above short-term bonds as shown in this chart. But as you can see, the present yield inversion is now below zero. The challenge with yield inversions is that they have been persistent leading indicators for recessions. Most of the recessions in the chart, the gray stripes, were preceded by yield curve inversions in the prior 1 to 12 months. Some might debate this correlation since, well, in 1991 and 2003, those recessions were induced by Gulf Wars I and II, and Federal Reserve policy was really a background factor. Correlation clearly does not imply causality, as the saying goes. The Fed paused its rate hiking campaign in July, and most other central banks around the world also moved into a pause mode. The global coordination reflects the fact that inflation really is a global phenomenon with a common cause, that is, constrained supply chains amid post-COVID demand recovery. Let's move back to the stock market. Bulls and bears have differing opinions on a handful of points, as you can see here. The top of the list is the Fed and the central banks. Bulls are enthused about prospects for rate cuts in 2024, as we saw back on slide 6. Bears, however, would note that even with the 5 rate cuts in 2024, the rates will still be high compared to historic norms over the last 20 years. And the Fed is dragging its feet with a higher for longer mantra, knowing how hard it is to get the inflation genie back in the bottle. Bulls would highlight that money market deposits are at all-time highs and that money on the sidelines will eventually need to be put to work in the stock market. Bears would point out that money on the sidelines may not head to the stock market since excess personal savings during quantitative easing has now been largely depleted. We'll chat a little bit more on this on subsequent slides. Bulls will also highlight that the stock market valuation is within norms over the last 10 years. Bears would not disagree, but would point out that valuations are high relative to the high rates that can be earned on bonds and even money markets. We'll chat about this as well on subsequent slides. Lastly, bulls will highlight the unexpected positive surprises in the stock market related to ingenuity, innovation, and invention. Bears, of course, will highlight the unexpected negative surprises, war, geopolitics, and acts of God. There's been a bit of an internal debate at the Federal Reserve about the drawdown of excess personal savings from the COVID era. The chart on the left was published by the San Francisco Fed in August and shows that all excess COVID savings have been drawn down and that Americans are likely to begin cutting spending imminently, clearly a recession threat. However, the chart on the right was published by the Boston Fed in November and uses a different base savings rate assumption and concludes that Americans have plenty of excess savings and that there is no need to cut back spending. We're inclined here to split the difference between the San Francisco Fed and the Boston Fed and conclude that savings have declined, but not to zero, and that consumers will slow spending, but not stop spending. Money market deposits continue to lift, now at nearly $6 trillion as shown on the left. Stock market bulls view this as money on the sidelines and future buying power for the stock market. Certainly the Fed lifting rates ever higher has been a big draw to money markets. Most money markets are now yielding over 5%. But if the Fed eventually starts cutting, then yes, there is now nearly $6 trillion in potential future buying power for the stock market. By comparison, the market value of the S&P 500 right now is at about $37 trillion. The chart on the right shows how well the stock market does after peaks in money market assets. The last 3 such periods saw annualized stock market returns of 16.4%, 19.3%, and 12.9%. These returns are quite favorable relative to the normal stock market return of about 10.1% and well above the money market returns. This chart shows the last 10 years of the S&P 500 in blue and the PE ratio of the S&P 500 in purple. As you can see, the S&P gained 215% over the last 10 years. In purple, you can see the price to earnings ratio has ranged from about 14 times to about 23 times over the last 10 years and is presently at 18.9 times, which is very near, maybe just above the middle of the historic range. Here we can see a comparison of the earnings yield of the S&P 500 to the yield on the benchmark 10-year Treasury bond. Whichever line is higher is the better value with this approach. As you can see, stocks remain the better value, but the higher rate environment has narrowed the lead considerably. We have reversed our aversion to the bond market in recent months and have started building bond ladders mainly using bullet bond ETFs. The year-to-date performance of the stock market has been dominated by the so-called Magnificent Seven mega-cap tech names: Amazon, Apple, Google, Microsoft, Meta, Nvidia, and Tesla. These 7 names are sprinkled throughout the technology, communications, and consumer cyclical sectors. As you can see at the chart on the bottom, the performance of these 3 sectors dwarfed the performance of the other 8 sectors. But most of the Magnificent Seven outperformance was contained in the first half of the year amid the enthusiasm about artificial intelligence and ChatGPT. In the last 3 months, technology still leads the market by a more modest amount though. Financials and industrials have risen to the 2nd and 3rd place respectively, likely on prospects for Fed rate cuts in 2024. Returns by style factor in the 4th quarter so far have been led by the 3 growth-oriented styles of story stocks, pure growth, and high beta. Conservative value styles have been lagging: income, pure value, and low volatility. It is interesting to compare the style ranking in the 4th quarter to that of the 3rd quarter since it appears to be a bit of a mirror image. Whatever outperformed in Q3 underperformed in Q4. Also interesting to see how the styles correlated with the monthly consumer price index inflation releases. A lift in CPI drove value styles to outperform, a drop in CPI led growth styles to outperform. For the year in total, the growth-oriented styles outperformed, also a mirror image of 2022, and also tied to CPI raising or lowering. The U.S. market has been better off than most of the rest of the world so far this year, up about 21.8% as of December 8th. A big driver was the action in the mega-cap tech names in the first half of the year on artificial intelligence and ChatGPT enthusiasm. A little surprising to see Europe up nearly 20% so far, despite having very few artificial intelligence plays in the indices. But the central bank was one of the last to pause rate hikes, and some level of relief rally was due. A number of geographies outperformed on the thesis of reshoring away from China. Vietnam, Mexico, Japan, Korea, India all did well. China itself still seems to be experiencing investment outflows mainly on the weak economy, excess debt, and geopolitical tension over Taiwan. Israel rebounded from the sell-off after the Hamas attacks, but is still a touch below zero so far in 2023. Overall, despite a few pockets of weakness, global market performance is doing reasonably well. We'd now like to move on to part two of our slideshow today, the economy. We'll begin with looking at GDP levels in the developed world. We touched on overseas weaknesses in our introductory slides. This chart puts some numbers on that weakness. Seems the most eye-catching aspect of this chart is how much of an outlier is the US compared to the rest of the world. GDP growth of 5.2% for the US in the third quarter is unmatched in the rest of the world. Seems our strong labor markets are driving increased spending on travel and entertainment. In contrast, most of Northern Europe is in technical recession right now, in particular the Scandinavian countries. Japan's economy is seeing its biggest contraction since COVID in the third quarter. We're seeing other soft patches in Brazil, South Africa, Australia, and even our neighbor to the north, Canada, is negative in the third quarter. Why is the US so strong when everywhere else is so weak? We touched on the fact that Americans have been spending their excess personal savings from the COVID era. This appears to be a US-only phenomenon, as shown here in the picture. This is not the first example of American consumers spending money irrespective of a jittery economic outlook. Inflation is coming down in most developed countries, as shown here. This is the main reason why central banks have paused their rate hiking campaigns. Inflation of 1.8% to 4.6% is still mostly above the central bank targets of about 2%. China remains an outlier on the low side, reflecting economic weakness. Russia, in contrast, remains an outlier on the high side, reflecting disruptions related to geopolitics. On slide 16, we touched on the stock market fixation on the CPI, the Consumer Price Index. While the CPI has been declining since peaking last June at over 9%, the monthly CPI report from the Bureau of Labor Statistics has not declined consistently every single month. As you can see here, the CPI upticked in July through September before resuming its downward trajectory in October. In those months with rising CPI, the stock market sold off sharply. But with the resumption of lower CPI inflation, the stock market has been roaring higher. This chart shows the last year of forecasts for the recession probability over the next 12 months, and it's using 4 different measures. We tend to gravitate towards the Bloomberg economics data, the series in purple, which is more of a consensus approach. That series still shows recession probability at 58%, which is not much different from where it was a year ago at 60%. Recession worry warts are likely to cite the present high interest rates, which are likely to remain higher for longer, the inverted yield curve, economic challenges in the rest of the world, and the fact that excess personal savings have declined significantly. Optimists, however, are inclined to cite the Fed's successful history of soft landings, the strength in the labor market, consumer confidence ongoing, and the very fact that the pessimists have been wrong for 12 straight months. This is the geopolitical risk index in red, and it spiked again with the Hamas attacks in Israel in early October. This is using the Caldara risk index, which uses a tally of newspaper articles covering geopolitical tension. So it's more a measure of newsworthiness of geopolitical tension rather than actual geopolitical tension. Naturally, amid the rise of geopolitical tension, we also have a rise in the prevalence of economic fragmentation or deglobalization. And of course, with many ripple effects to blue chip equities, most of which are indeed global businesses. 2024 is a presidential election year, which means analysts will be trying to connect the stock market performance to the expected election outcomes. As you can see here, the average market return in an election year is 11.6% going back to 1928. Actually not a whole lot different than the 10.1% return over the last 100 years. Also, the year after the election, the average return is about 10.7%. Again, not a whole lot different than the long-term average. However, the variance is enormous, ranging from the 38% decline in 2008 when Obama won the election, but in the midst of a subprime crisis. And we had the rise of 42% in 1928 when Hoover won, but that was amid the roaring stock market of the 1920s. So while the election is big, the stock market is about more than just who becomes president. It's also about things like technology advances, Fed policy, medical breakthroughs, wars in other countries, weather events like tsunamis and hurricanes, fashion changes, popular movies, and so much more. We do not yet know for certain who the presidential candidates are at this point, so it's hard to lay out specific biases about which stocks will do well under which president. However, we do have the consensus view from just before the 2020 election about which sectors will do well under either Biden or Trump. This seems to be a good place to start since the 2024 candidates are not likely to stray too far away from their party lines. A few tweaks are in order, though. First, China stocks have done poorly under both Trump and Biden, thanks to the geopolitical bullying down in the South China Sea. That seems unlikely to change in 2024. Also, health insurance may be a little bit less contentious with the 2022 legislative changes to allow Medicare to begin negotiating with drug companies. Lastly, budget issues seem likely to become more contentious. So this chart will be tweaked further as we gain more certainty on the actual candidates in 2024, but this seems to be a good place to start. We'd now like to move on to part 3 of the slideshow, shifting from macroeconomics to microeconomics by looking at a handful of industry-specific factors that are shaping overall capital markets. As you can see here, we're going to be highlighting 5 industry discussion topics: mega cap techs, non-US real estate, Bitcoin, oil, and gene editing. In the first half of the year, the mega cap tech stocks roared, partly on new advances in artificial intelligence and ChatGPT, and partly on a reversion to the mean after being oversold so heavily in 2022. But in the back half of the year, the Magnificent Seven, well, they've barely squeaked ahead of the market. Seems the street has now raised expectations to a level where the stocks are seeing limited reaction to positive earnings growth. The Magnificent Seven have played an outsized role in generating alpha or outperformance for most of the last decade. 2022 was the only year where the Magnificent Seven meaningfully underperformed the market, and 2023 so far seems to be making up for that outcome. Though again, almost all the alpha in 2023 was earned in the first half of the year. The Magnificent Seven are likely to continue to dominate markets, owing at least in part to their enormous size and index weightings. But all 7 retain deep moats, above average organic growth, and very high returns on invested capital. More alpha seems likely in 2024, though some reversion is possible in the more overbought names. Shifting now to the topic of non-US real estate. Over the last 14 years, residential property prices in the US have outperformed those in Europe and Japan. But with the central banks around the world becoming more hawkish in 2022 and 2023, residential property prices have stopped increasing in most of the developed world. Higher mortgage rates are not a US-only phenomenon. Mortgage rates have lifted higher in most regions of the world, with the lift in the US mortgage rates being higher than most of the developed world. US mortgage rates are now over 7%, or 7.4% on this chart as of November. Home sales transactions have slowed to a crawl worldwide. The slowdown in home sales transactions has weighed heavily on home builders everywhere in the world except the US. Indeed, the US home builders are posting near record earnings despite the higher mortgage rates. US home builders explain the paradox. The higher mortgage rates have frozen the potential inventory of existing homes for sale, since no one wants to swap a 3% existing mortgage to buy another home with a new 7.4% mortgage. The inventory dearth then means that serious home buyers can only find inventory from builders of brand new homes. So why is this not happening outside the US? Well, the non-US markets are all near recession, and the weak economies are constraining demand to a level that's even below the scarce inventory of homes for sale. This seems to be another example where Americans are the only spenders. It also raises an interesting potential opportunity to arbitrage a possible reconciliation between the US and the rest of the world. One more slide on real estate before we move into the Bitcoin topic. But real estate cap rates have a very loose correlation with long-term interest rates. But chat with any commercial real estate pro and there's little acknowledgement that cap rates have moved at all since the Fed began its rate hiking campaign nearly 2 years ago. Yet cap rates have lifted as shown here. This also means that if the Fed cuts rates in 2024 as expected, the cap rates will loosely track the more dovish central policy. So cap rates indeed seem likely to peak sometime in 2024. Bitcoin has been topical again as the cryptocurrency is up a strong 148% so far this year. Of course, it's still 41% below its 2021 peak, but 2023 has been a good year for Bitcoin. There are many reasons for the rally. Geopolitical tensions creating demand for an alternative monetary asset, reversion from the 2022 underperformance, correlation with story stocks, which have also done well in 2023, anticipation of a halving or a stock split, so to speak, in 2024, a possible spot ETF offering, and rising production costs. Now let's talk a little bit more about those production costs. As we can see here, Bitcoin production costs have acted as a bit of a floor for the price of Bitcoin over the past decade, and production costs continue to escalate. Electricity prices in particular are very unlikely to see rate declines as grids worldwide transition away from low cost but high carbon sources. Now the production cost as a floor, that is a bit of a psychological floor since Bitcoin never really gets consumed, unlike other commodities like say oil. Still, it appears that psychological floor will stay with us, and the Bitcoin rally will likely have legs, especially if story stocks continue to rally. In our slideshow last quarter, we chatted about the mysterious rise in crude oil and the collapse in the crack spread, and the seeming opportunity to either short the crude oil or long the crack spread. Seems we can take a bit of a victory lap on that idea as the crude price has dropped back to near its low for the year, as shown in the top picture at the left. But at the same time, the reversion coincided with the Hamas attacks on Israel. Does this mean that the crude oil producers in the Middle East knew that the attack was afoot? The Economist last week published a piece showing extremely large short sales were made on the Israel ETF, and option contracts on US listed Israeli companies rose eightfold, but only for the contracts expiring in October. The Hamas attacks earned these traders millions. The Economist did not discuss trades made in the more liquid commodity markets, nor in the currency markets, but the directionality of the movements fits the old adage of buy on rumor, sell on news. With the news of the Hamas attacks now digested and the oil price back below $70 a barrel, it seems likely that we have entered a new and lower trading range. Yes, OPEC Plus has been making noise of reducing production, a headline that moved oil in the weeks before the Hamas attacks, but not after the Hamas attacks. Rig counts have stopped declining and may even rise with the new Middle East tension. Crack spread has improved a bit and seems likely to creep higher, which suggests gasoline may have some upside from here. Medical breakthroughs are always exciting. In our last two webinars, we discussed the GLP-1 obesity and diabetes drugs, Ozempic and Mounjaro, and we also discussed the breakthroughs in Alzheimer's with Leqembi and donanemab. The breakthrough of the current quarter is in the gene editing space. Just last week, the FDA approved Casgevy for sickle cell disease. This is the first ever approval of a gene editing therapy, and this is not a treatment for sickle cell disease. This is a cure. The approval is a beacon of hope for cure for other genetic diseases which now have the potential for an outright cure based on new gene editing technology. And there are lots of genetic diseases. Casgevy is made by CRISPR Therapeutics of Switzerland, one of a handful of biotechnology companies that specialize in gene editing. The stock has done quite well this year, as you can see, up 43% in 2023, and well above its gene editing peer group. As exciting as the gene editing breakthrough is, the stocks have actually done fairly poorly in recent years when viewed on a longer term basis. In fact, most of the gene editing stocks peaked back in 2021, along with the peak in the COVID era market bubble, especially the bubble in story stocks. And while story stocks have bounced in 2023, the gene editing space has just simply not recovered. We are more constructive on the gene editing stocks today. Recall, we have been bearish on the group, reflecting elevated valuations and a lack of conviction about pipeline success rates. Indeed, our long-short strategy has had several very fruitful short positions in Intelia, Beam, and Editas over the past 3 years. But we're revisiting our prior bearish view. This partly reflects the sizable correction in the valuations, but it also reflects more evidence that the gene editing may actually see better pipeline success rates than overall averages. We would like to conclude our slideshow with one additional slide with a top-down and longer-term view. This slide shows that over time, markets go up more than they go down. And it shows there's quite a variance in any given year. Interesting too that the average return of just over 10% is actually not a very common return. Indeed, the average return bar shown in peak near the middle shows that we only had 6 average years over the last 96 years. It's more common to have great years or bear years than it is to have average years. Certainly the last 5 years would be good examples, with 2022 being down 18%, 2019 being up 31%. In the stock market, patience really is a virtue. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.